And I think that's kind of where we want to zero in, John, when you talk about what's going to happen. If there is a default, there's going to be a whiplash in the markets initially.
Yeah, and let's clarify something. Let's first of all define the word default. Default means that you don't make a payment on a debt. And according to Brian Westbury, who is an economist with First Trust, he has looked at all this information and he has said that there is plenty of money to pay the debt service that we have on the existing debt. But what that would mean is that there would be a lot of other interruptions in terms of government contracts, in terms of Social Security, government payments to their workers. A lot of catastrophic things would happen, but we would not necessarily default on a debt. Now, that being said, if we don't default, but all those other things happen, which is kind of what happened in 2011, we're going to see some economic pain. We're going to see the stock market sell off greatly. We're going to see people without jobs. We're going to see interest rates rise. We're going to see inflation go through the roof. We're going to see a lot of damage and that's the brinksmanship, Scott, that I was talking about earlier. The closer we get to that deadline, whatever that deadline is, the more that we would actually see the hurt happen in terms of the economy and the markets. And I think we've got an example of this. And while the short-term pain would actually be pretty rough, this is what happened in 2011. Longer term, this tends to work itself out.
Yeah, so 2011, you alluded to that earlier, and when we were talking about Social Security, that was when the debt ceiling crisis ended in no deal struck, and the Standard & Poor's lowered the quality of U.S. debt, and that sent the market into a turmoil. Can we go back to the 2011, just kind of hang out on that just a minute? Because that is so that's what happened. We went from between 1750 and 1800 on the S&P 500 down to below 1550 over about a 6-month period of time there from March to September. But then it came back up once things worked itself out. And then now if we go to that second slide, that shows you really the knothole versus the full forest, right? We talk about that all the time. The knothole is what's happening today, what's happening over a 6-month period of time, maybe even a year's time. But you see what a blip on the radar it is for those of you watching on the video version of the show, where we were in 2011 versus where we are now, or even if you just pick 2014, 2013, it did work itself out. So again, it's just the crisis of the day on one hand, but the other sad part of this, John, is it's something long-term, and we're not going to get into politics here, but the reality is the long-term debt and the interest on that debt, the prevalence of out-of-control spending, something's going to have to give, and it's probably going to be higher taxes is probably what's going to happen.
Yeah, and let's really try to dig deep into this for just a second, Scott. There's only so much money in the economy that is going to go to buy debt instruments, bonds. And that's what the government issues. They issue a bond, which is essentially an IOU, and people buy government bonds in order to get the interest on that. But there is a limited supply of money that will actually flow toward debt instruments in the overall global economy. I am afraid that we're going to hit a point at some point in time where there's no more money to borrow. And when that happens, then we have to do something. But what this is doing in the meantime is it's actually taking away capital from debt instruments of private businesses that need to borrow money for whatever reason, and it's causing them to have to pay higher interest rates to actually attract that money. And so this is a big problem. It's not just about taxing and spending. It's really about the overall integrity of the global financial system. And America is so big and our debt is so big, we have got to do something to get this under control. And as I said earlier in the show, I believe that clearly, do we need to avoid a crisis right now? Yes, maybe bump up the debt ceiling a little bit right now, but we've got to go back and enact some very legitimate spending cuts. And those things have to happen. Santa Claus is not real. There is just no fairy tale out there that you're going to just this endless supply of money. I just don't buy into that because of exactly what I said a minute ago. There's a limited supply of capital that flows to the debt markets. And so when you think about that, then you go, okay, we've got to do something with this. And I think that's really what the point of the Republican side of this debate is that they're trying to force this issue now. The problem is they've waited almost too late with this current cycle of the debt ceiling to try to trigger that.